Ladies and gentlemen, good day and welcome to Max Financial Services Limited Q1FY22 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jatin Khanna, CFO at Max Financial Services. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. Thank you for being part of Max Financial Services earnings call. My name is Jatin Khanna, CFO for Max Financial Services. Before proceeding with the performance highlights, I'd like to introduce my other colleagues who are with me on this call. I have with me Mr. Prashant Tripathi, Managing Director and CEO of Max Life, and Mr. Amrit Singh, the CFO and Head of Strategy for Max Life. I'd like to begin with the transaction updates first and then get on to the performance. As you know, we concluded the transaction for Axis to become the co-promoter of Max Life with 13% stake this quarter. We have now got on to the third step of the transaction and filed application with IRDA for acquiring residual stake of 5.17% from MSI in Max Life at 85 rupees a share. Significant value creation is expected once this transaction is completed, considering that the price is quite attractive. We are hopeful of concluding this transaction in the current quarter. The next step will be ready for Axis to acquire the balance 7%, which we expect them to do sometime next year. I imagine that you'll have some more nuanced questions around the transaction. However, since we are still to conclude many other steps of the transaction, my request will be to refrain seeking any further detail of the transaction at this stage. We'll be happy to address that at an appropriate time. I will request you to restrict your questions on the call on the business performance. So now, quick highlights for our business performance for Q1 FY22. Our consolidated revenue, excluding investment income, for Q1 FY22 was rupees 3,420 crore, a strong growth of 27% in the most challenging business environment. The consolidated profit after tax declined by 80% to rupees 36 crore relative to the same quarter last year, which had one-off tax refunds, lower operating expenses, and lower debt claims due to COVID-19-induced lockdown. Moving on to the key business highlights for Max Life. Despite COVID wave 2 headwinds, on a 2-year CAGR basis, Max Life registered highest sales and highest VNB growth among the top 4 players, which is an incredible performance in the most challenging times for our country. Max Life individual APE has grown by 32% to 875 crore in Q1 FY22. Market share improved by 63 bps to 11.3%. Our value of new business as to be 172 crore in Q1 FY22 has grown by about 53% year-on-year, which is again a very, very strong growth. Our NBMs have also expanded on a year-on-year basis by about 260 bps to about 19.7%. The NCEV has grown by about 15% to 12,290 crore. The first quarter is seasonally a low quarter, and which is why the margins and NCEV growth will typically always be the lowest in the first quarter, and then it catches up as the year progresses. NCEV on an operating basis has grown at about 13.5% annualized, including non-operating variances. The ROEV is 16.3%. The operating ROEV for Q1 FY21 was relatively higher due to positive operating variances in form of tax refunds, which is 63 crore, and also due to delayed reporting of claims in the same quarter last year because of the lockdown. Adjusting for same, the operating ROEV for Q1 FY22 is actually better than last year, of the same quarter last year. Given it's seasonal, so obviously the first quarter tends to be lower. The gross premium grew by 27% to 3,484 crore in Q1 FY22, and the renewal premiums grew by 21% to 2,244 crore. 13-month persistency improved by 317 bps to 85.1%, and 61st month by 160 bps to 54%. Claims paid ratio improved by 13 basis to 99.35% in FY21. Impact of COVID wave 2 for Max Life, has been 3 to 4x severe relative to that of the first wave, and so has it been for the industry. Claim experience is higher than expected across all lines of businesses currently. The higher claims trend consistent across other life insurers, and few players created additional reserves in Q1 FY22 to absorb the higher claims. I'm pleased to report that we were carrying adequate reserves, and therefore the pandemic reserve of about 500 crore which we created in Q4 FY21 really helped us to withstand this entire COVID wave 2. The financial strain in the first quarter because of the wave 2 is about 234 crores on the shareholders due to these excess claims, which were utilized by the pandemic reserves, as I said, with no impact on the shareholder PML. Even though our long-term opportunity continues to be attractive on the protection business, however, given the ongoing pandemic, we are taking a bit of a cautious approach on the business, and really, we have put additional underwriting controls in place. As a consequence, our overall protection contribution has reduced from 24.5% to 18%. The individual sum assured of new business also declined by 30% in Q1 FY22 due to the degrowth in protection business, while our market share improved to 16.1%. So relative to the others, it still continues to be trend better. Our solvency surplus is about 1,400 crore with solvency ratio of about 197%. Pleased to report that we raised another 500 crores this quarter through a non-convertible debenture issuance, and which has strengthened our solvency margin to about 214%. Our AUM as of June end stood at 94,000 crore, growing at 28% YOY, led by growth in unit-linked funds, and our AUM of 39% and 23% respectively. Max Life is now the fourth largest manager of life insurance AUM. We've also filed an application for pension fund manager license to PFRDA, which is ready to participate in the overall retirement ecosystem, driven by our focus on, getting into annuities in a big way. Max Life improved its ranking by 6 places to 18th among the great places to work for in 2021, and among top 25 best places to work for a second year in a row. For the first time, we've been recognized among the top 100 great places to work in Asia, and have been ranked 55, the only life insurance company in India, or insurance company in India actually to really achieve this. So in summary, Max Life will continue its trajectory to deliver strong, of driving strong shareholder outcomes, with Axis now on board as a new JV partner. There's good progress which has been made on the 5 pillars of Max Life strategy with predictable and sustainable growth, product innovation to drive margins, customer centricity across the value chain, and digitization and analytics as a foundation and augment human capital. So really, there's good progress being made on all the 5 pillars of our strategy. Now with Axis partnership having been strengthened and Yes Bank assuring arrangement renewed for another 5 years, Max Life is under the process of recrafting its strategic place and has identified the following key focus areas. Leadership in digital distribution across both the sort of spectrum, in the sense that old assets as well as aggregators and other ecosystems. So we really want to sort of establish a leadership in the digital distribution. We want to be amongst the fastest growing profitable proprietary channels in the country. We would like to consolidate and build our leadership position in protection business, as well as strengthen our position in health and retirement space by providing holistic offerings to customers. And lastly, actively evaluate inorganic opportunities to build distribution and insurtech capabilities. So these will really be our focus areas going forward in terms of how we will want to differentiate and position Max Life relative to the other players in the life insurance space. And on that note, I will hand over to moderator to open the floor for Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and one. First question is from the line of Sanket Godha from Spark Capital. Please go ahead.
Thank you for the opportunity. Can we get the VNB walk from fourth quarter FY21 to one quarter FY22? So the 25.9 getting declining to 19.7. Though we understand that is seasonal in nature, but just wanted to understand the negative operating leverage, how much it impacted, and then how much it was due to the product mix change. Just from the moment from full year to first quarter number. So that was my first question. And I have two more. If you answer this, then I can ask another two. Yeah. Hello.
Amrit, will you take this question?
Yeah, Sanket. The exact walk, obviously I don't have it offhand, but the large reason for it is the product mix, which actually is a higher proportion of protection, higher proportion of non-par versus how this quarter has been, which has been a bit more over-indexed on ULIPs. And this was also the case last year as well. If you will recall, even last year, same time in the first quarter, our ULIP mix was higher. And as the year kind of progressed through, other product categories actually, the proportion started increasing during the year. And we expect to do something similar even in this year as things kind of move forward.
So let me give you maybe a clear number. Adjusted for expense, Sanket, if we were to make adjustment for expense, which means we keep the expense on a run rate basis for the full year rather than lumping it all in the first quarter, because first quarter is generally small, so the seasonality, adjusting for seasonality in expenses, this 19.7 will be somewhere around 23%. So this 25.9 to 23, which is 2.9% delta, is predominantly because of higher ULIP mix. Now, this higher ULIP mix, generally is a phenomena that we see in the first quarter. It has happened last year also. It happened only from our bank channels. As things appear right now, to a great extent, the ULIP bias has been corrected, and we expect that going forward, some bit of that product mix related challenges will be corrected. So sitting today, Sanket, if your question is, and I'm just guessing, your question is, do you have a permanent impact on the margin profile of the organization going forward because of change in product mix? The emphatic answer to that, from my perspective, is no.
Okay. Perfect. So you are confident that by end of the year you will be still in the 25-26 range by end of the year with the change in.
Unless there is a wave 3 or wave 4.
Okay, got it.
I think as management we are reasonably comfortable that we will be able to come back to the numbers. This first quarter low margin number is a phenomena that you will see for Max Life Insurance every year. If you go back last 4 years also, you will see the same phenomena. As things stand, the month of July, August, the product mix has been, significant steps have been taken by our bank partners, ourselves, to rebalance the product mix in a manner that the margin will get optimized. So I'm, a reasonable level of confidence that we should be able to come back to margin numbers that we delivered last year overall.
Got it. Perfect. And the second question was basically the interest cost on NCDs for the solvency which we have raised. How much likely impact it will be on the margins for EV, because that's a permanent cost which we'll have in our forecast going ahead. So likely impact of it on the margins, if you can just tell me, that will be also useful in that sense. Assuming the product mix remains very similar to what it is at the end of FY21.
Amrit, do you have any number?
So, Sanket, you know that this is surplus capital only. So obviously we have a strategy of deploying this capital in similar yield generating assets. So this cost drag is actually very insignificant. Because if I have raised it at a 7.5% rate, I will, in the range bound itself, be investing it immediately, and this being surplus capital. So the drag on the financials is actually very, very insignificant.
Got it. Perfect. This explains.
I mean, even if you were to push really hard, Sanket, and talk about, say, your earn rate, or whether your earn rate will be 7.5 or not, or will it be 6.5? A 1% delta on 500 crore number is like 5 crore. It's insignificant to any.
Got it. Fair point. Sorry. Yeah. And finally, we are saying that we are going to increase the prices from July onwards. So is it driven by more because we had one more round of reinsurance rate hardening, or is it because of the divergence at the current price with respect to mortality on our own without no dictates from the reinsurers? We are increasing the prices. Just wanted to understand the color why we are approaching that by increasing the prices.
It is to factor in some of the price increases from the reinsurance companies, which is what we are now implementing.
Oh, okay. So the last part, whatever you will increase in July month, from July month onwards, is largely because of hardening of reinsurance rates, right? Right? Is it
predominant? And basically, when the insurance rates go up to when we start to reflect in the price, there is generally a lead time. So that lead time, it took us maybe a few weeks to do that, but now it's been implemented.
Fine, perfect. And finally, out of 500 crores, 234 is utilized. You are still sitting on 260 odd crores to take any third, fourth wave kind of a impact on COVID claims, right?
No, so let me just clarify. I think this is a very important question that you asked, Sanket, and I will draw the attention of everybody else. The wave 2 came in the month of April and May, and some part of June. That was wave 2. Now, when the deaths take place to when the claims are raised, generally there's a lead time. Sanket, you'll appreciate that there'll be a lead time. The lead time is 6 to 8 to 10 weeks by when you start to receive the claims. People intimate you, then you inform them that these are the documents which are needed. So that back and forth actually takes 8-10 weeks time. Then you would expect the peak to come and then the peak to settle down. So the claims that you see that we have handled until June may not be all the claims of wave 2. We expect that wave 2 claims will come, and you would have seen in some of our peers disclosures also. They have made provisions, etc., to take care of claims of wave 2. So this 266 crore is not about wave 3 or wave 4, etc. Some part of that will get utilized in wave 2 also, because we are expecting that the claims will continue to keep in the month of July. Is that a fair explanation? Okay.
Fair point. But given you are already in the middle of August, So maybe a last point, if I can squeeze, related to this question only. So given you are already 40 days past the second wave of the first quarter, have you seen that the 266 will be fully utilized, or you still carry a buffer by the end of the year? That's the only question I have.
It's very hard to say, because we are still seeing wave 2 claims come through. Some of the wave 2 claims are still coming. Until we have some visibility on whether the claims have vanished or have completely gone, etc. Very hard to comment. Sanket, I will give ourselves perhaps a few more weeks. Like I mentioned to you, it is like a normal distribution curve where the peak comes 6-8 weeks after the death has taken place, but the tail of the normal distribution just continues for a little while. We have to wait for maybe 4-5 weeks to completely ascertain how much of that we consume.
Thank you. Sanket, request you to join the queue for any follow-ups. We have the next question from the line of Nitin Agarwal from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, just continuing on this, like the residual provisions that we are now left with, do you think that they will be sufficient? Because as you were indicating, like 8 to 10 weeks is what it takes, and the wave 2 was there till June. So, will this much provisioning be enough, and any color on IBNR claims that you can provide?
Yes, thank you, Neeraj. Basically, IBNR is on the basis of expectation of the claims which we're expecting, and that's generally a part of the financials. So I will just maybe refer it subsequently to Amrit to talk about the IBNR. But this 266 crore, unfortunately, very hard for me to say whether this is going to be enough because claims continue to come. But I think I'm reasonably sure that we will be able to keep it P&L neutral with the help of these provisions, if required, some more provisions which are already in the balance sheet to take care and make it P&L neutral as far as wave 2 is concerned. So I think from a profit and loss statement perspective, we feel that we are reasonably confident that we'll be able to manage wave 2. Over to you, Amrit.
So on IBNR, firstly, IBNR is actually computed basis how the past trends of delays actually are, and that's the logic that is kind of used. As we sit in the first quarter end, we would have IBNR of around 150 crores plus kind of a number.
Okay, sure. And a question on the protection business, like this quarter, like in claims, we have seen typically say almost a 50% higher ticket size in terms of claims that we have seen on the protection side. Does this not look higher? While I know that most other companies also have reported an increase in ticket size in terms of claims that they have received in respect to COVID-2, but because COVID-2 was more rural in terms of its impact, so these ticket sizes ought to be lower versus what the industry is seeing as a whole. So just curious on why this divergence.
Nitin, actually, so what is your specific question? Are you saying claims on protection have doubled? Or your question is ticket size of protection policies have...
Yeah, ticket size. Claims, I understand the impact was much more of COVID-2, casualties were higher. But why the ticket size also are 50-60% higher? Because this time the impact was more rural.
Yeah, so it's not a sum assured play, and it's neither is it a market or a customer segment kind of a play. I think that has remained fairly consistent. It is a bit of a mixed change which has happened towards limited pay designs, which would have which you can see from a case size perspective.
Okay, and lastly on the tariff hike, we have not taken any tariff hikes during the first quarter, because if I look at the average case size, the protection ticket size is up by 35% for the quarter. So have we taken any hike during Q1 also?
So we had an introduction of a new product, and Q1 typically is a transitory period also, Nitin. So we had an introduction of a new product, which was at the margin a little higher from a price perspective, not significant, but the significant price hike was taken in the month of July, at the start of the July.
Okay, sure. Thanks so much.
Thank you. Before we move to the next participants, we request all participants to limit their question to 2 per participant. If time permits, you may join the queue for any follow-up. The next question is on the line of Madhukar Ladha from LRS Capital. Please go ahead.
Morning, everyone. Thank you for taking my question. So first on this COVID claims bit, can we quantify what is the total net COVID claims for 1Q this year, and what was it net for FY21? So by net, I mean net of reinsurance, what was the hit?
So I think Prashant spoke about this, Madhukar. Firstly, as these claims are trickling down and the sharp discernment of the COVID marking and the non-COVID marking is taking a bit longer, because we are thoroughly investigating the specific reasons of death as well. But this 235 crores which has been utilized, you can largely attribute towards COVID claims actually.
Understood. And we've not created any additional reserves, right? So it's just 500 crores. No additional reserves were created in this quarter.
That's correct.
Okay. And one question I had on the group credit side. So I think that's still a very small percentage in our APE mix. And I think we're still largely group term insurance. Correct me if I'm wrong. But given now, with this Axis partnership, we know that Axis also uses other partners. Is there any change in thinking towards moving more business and credit protect towards Max Life? Hello.
Yeah, hi. Okay. Because we are all not together in one room, there's a little bit of confusion between Amrit and I, but I'll take this question.
Sure.
As you know, the group term life is a yearly renewable thing, whereas credit life is a single premium paid for many years. So while in crores of rupees, which is premium received, we do significantly higher credit life, but when you make the APE adjustment, which means you leave the yearly renewable as it is and you divide the credit life by 10, it starts to appear a bit smaller. So just to clarify, in terms of numbers of crores, we write significantly higher credit life business. I think the relationship with Axis Bank is very promising, and we've been writing with the credit life business with Axis Bank for more than a decade. So they have been always the single biggest contributor to our credit life business. In addition, we have significant relationships with the other bank partners, Yes Bank, and many other partners that we signed up. Again, like any other organization, we are commercially savvy about this business. We look at profitability, and this business has been growing quite significantly. Even in Q1, we have seen big growth come through in the credit life business. So theoretically speaking, of course, one would expect that with our relationship with Axis Bank strengthening, this part of the business will continue to grow. But at the same time, I have always mentioned in past that credit life business is a business that we are tactical about, we're not strategic about. We are providers of predominantly individual policies, and that will remain our focus area. So this part will grow. You would expect that with Axis Bank coming on board, we'll get the impetus. But a large part of our margin driver will continue to be individual business.
So can you provide a sort of a split, if it's possible, in the credit protect business? What percentage of it is coming from Axis? And just one final question.
Close to about 60%. Close to about 60% comes from Axis Bank.
Okay. And I think amongst our peers, I think we are the only insurance company that has seen an increase in the individual protection reinsurance rates. So I just wanted to understand that why is that the case? Is there anything specific in our business as a result of which this has happened, or it's just a matter of time that even others probably foresee something of the sort? Yeah.
Amrit, you may take the question, please.
Yeah. So among the peers, there is, and I'm assuming you're comparing the top four, but on a generic trend for the industry, I would say that that statement might not be true, because this hike has kind of come across other players as well. Now, among the top four, two of them, I think, given the lay of land for them, where they don't operate in an open architecture environment, their pricing of the protection product is also very different than how it is for us. But whereas for us, who is actually operating in an open architecture environment, we do try to optimize for the pricing, keeping all things in considerations around brand, related strength, etc., to ensure that we optimize for it. Now, so maybe some of those players that you're hearing from, they are probably indicating some of this. However, in our assessment, it is probably only a timing thing. I think the reinsurers have been assessing the implications of COVID, especially the long-term assessments of that, and some of that they are actually doing as a play across providers. Now, specifically, is our portfolio any different or with respect to sourcing quality, stringent quality? We have been given to understand, especially in these reinsurance conversation itself, that there is no such thing. In fact, we continue to have a fairly superior overall underwriting quality play in the books, and has been the case even in the past. COVID is a recent phenomenon. I think all reinsurers are also grappling with COVID as a recent phenomenon and what long-term implications of COVID would be. And some of that might play out for other players as well.
Thank
Hello?
you. Yes. We'll take the next question from the line of Ajax Frederick from BNK Securities. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, on retail protection, since we are focusing on ROP, why is the growth still slower? Because some of the peers who have been focusing on ROP are doing much better than the others who are focusing on pure term. So what are your thoughts there? That's one. Again, an answer to the question to that is, since we are going ahead with the rate hike, that would have factored in the probable mortality risk in future as well. So why are we going cautious again, given that the rate hike has happened? So those are the two questions on protection.
So, Ajax, firstly, I think the ROP proportion for us has remained fairly constant over a period that you're comparing. So that is not as if that we have increased ROP within our mix. It has remained largely constant. So there isn't, a play of saying that we have increased the ROP and hence overall value should have increased. Now, coming to your questions of why we are going cautious about it, I think wave 2 was fairly grave and fairly unfortunate. And as we have seen so far, and more and more data kind of keeps coming through, we have seen the intensity to be almost 3 to 4 times of how the wave 1 intensity was. Now, during these times, actually, it is imperative that the protection book that we are onboarding, we have just enhanced the diligence of it. We used to, practice telemedicals and video medicals where a doctor would speak with the customer. We have modified a little bit of that, and we are ensuring that actually all customers undergo a necessary medical test, so as to ensure that we are onboarding good quality lives, especially during this uncertain period of the pandemic which is ongoing. As things will progress in future, I think the pace at which vaccinations are happening, the efficacy of vaccinations is something that we are watching for, and that's the reason for actually building additional prudence. Even globally, you see there is a resurgence of wave 3, which happened, and though from a mortality perspective, the implications were far lesser, though the infection rates were higher. I think it is just for us to wait out and pan out, because you will recall all of this quarter was the quarter when actually both in the month of April and May, the pandemic was at its highest actually. So we would like to wait out and see out for a couple of more quarters to see how the pandemic actually behaves and the implications of pandemic.
But overall, I must reiterate for the benefit of everyone, and especially answering your question, that protection is a very strategic area for Max Life Insurance. We have called that out as a key area where we want to grow. We will continue to drive our way through and increase the share of protection. We will always work towards coming up with competitively priced products which can help us garner market share. And we will work with our insurance partners and our underwriting process to make it more, frictionless. So that commitment just continues. It's more tactical, keeping in mind, the way wave 2 came, keeping in mind some of the uncertainties right now. It's not as if we have stopped writing protection business, as you can see, in terms of percentage individual protection business. In terms of percentage of sales, we are still very competitive. Our run rate in quarter 1 is actually more than perhaps quarter 3 and quarter 4. So we are showing protection with confidence. It's just that why isn't it equal to last year in terms of percentage? Predominantly because last year, the demand perhaps was a bit higher than how it is this year, and also our underwriting grids, after having seen the experience of first wave and second wave, and in consultation with the reinsurance providers, are a bit more stringent. Needless to say, that's how it should be.
Got it.
I think the 2-year CAGR, Ajox, if you see, is 35% for us on protection business as well. So it was on a high base that there is a decline, but if you see a 2-year CAGR, it's still 35%.
Got it, sir. So going forward, starting August, you will be challenged with a high base on Smart Wealth plan, which is the non-par piece. So what is our stance there? Because just the outlook on non-par, because that has been our driving growth driver or the engine for growth till now. So what's the view of them?
So there could be quarters or months of all up or down. Really, I mean, at my level, at our level, we don't worry too much about it. The business, last year we made significant improvement in our margins. We went up from 21% odd to about 25.2%. The objective this year, like I mentioned in response to the first question, will be to maintain or improve the margin at a total level for the full year. The other element that we have is try to drive sales growth. And you would have seen that in first quarter, we again gained market share. We are trying to keep the sales propped up so that overall we are able to grow our VNB. So, at a very high level, despite a very high base effect, and you may recall that with respect to peers who were more in the range of single-digit growth on VNB, we grew 39%. Despite on that higher VNB growth, the business is very confident, and we're working towards driving it further with a very strong double-digit growth rate, at least aligned to the sales growth numbers. That's really the strategy for this year. And, sitting today just over the hump by the horrendous first quarter where, all the business struggled, sitting in July, that's the level of confidence that we have, that we will be able to churn these numbers and we will be able to maintain our growth trajectory.
Thank you, Mr. Fredericks. Requested to join the queue for any follow-up. Also, participants are requested to limit the question to 2 per participant. The next question is from the line of Anirudh Shetty from Solidarity Investment Managers. Please go ahead.
Hello?
Yes, Anirudh, please go ahead with the question.
Yeah, I have 2 questions. So my first question was more on the group protection business. Obviously, some of your peers are fairly optimistic about it, while some have become more cautious. Wanted to know your stand on this particular product, and how do you see this growing, and what kind of profits can one assume to make in this business?
I can tell you, based on all my experience of close to 15 years in the business, that especially if you're looking at group term life, which is the GTL business, which is employer-employee kind of a business, there may be tactical opportunities for any companies to participate and maybe prop up some bit of recovery or say profit for this year. But I can tell you that kind of profit may not be sustainable, because once the COVID settles and the employers go out in the market to take quotes, there'll be competitive quotes. So really, some of these margins are not sustainable. Now, having said that, is Max Life Insurance quite focused to tactically leverage the opportunity, which and through price take more risk? The answer to that is also yes. In fact, in some of our policies, we are trying to do that. But is that a sustainable strategy which will continue to churn huge EV to the companies over a long period of time? I fear that may not be possible. On credit protect business, of course, that's a sustainable business. It is similar to individual business, just that it comes in form of group, but it is more individual than group. There, of course, sustainability will be similar to how it is.
Okay. And my second question is, I just wanted to understand, I was going through your sensitivity table, and I saw that your VNB sensitivity to reduction in risk-free is -7. So I just want to understand what is the reason for that. And I don't know if it correlates with this, but our non-par book is about 33%. So just want to understand what is our hedging strategy over there.
Amrit, you will have to take this.
Yeah. So sensitivity, actually on VNB sensitivity especially, it's a mix of the product that you're driving, par, non-par, etc. But and it is a point in time kind of a sensitivity. It does not take into a consequent action that you can take with respect to repricing your products or let's say adjusting the bonus rates from a par policy holder perspective. So if that interest rate had to move, it does not mean that we will end up actually having a decline of VNB of that number, because we will take consequent actions with respect to pricing to ensure that those corrections will happen. So that's the first point. On the second one, on hedging, we used ever since we have been writing a non-par business, we have been hedging this particular business, and at the initial period of time we used to use tools like interest rate swaps. At this point in time, the dominant strategy for hedging is forward rate agreements. From a capability perspective, as an organization, we have capability to use IRS, IRFs, FRAs, even some experiments on partly paid up bonds, etc. But the dominant strategy in play right now is FRAs, forward rate agreements. And we do hedge our non-par business, adjusting for persistency assumption into the full extent cost. And this hedging happens actually on a monthly basis. So all the month that has been written, it gets hedged immediately the month.
Under this question answered.
Sorry,
We have lost the line for Anirudh, sir. We'll move to the next question. That is from the line of Hardik Shah from SBI Mutual Fund. Please go ahead.
Yeah, hi. So I have a question on reinsurance. So basically, given the experience of the claims, have you changed your reinsurance strategy in terms of how much of your term business or life protection business would you be reinsuring?
So, Hardik, the reinsurance strategy remains same. We, in case of term business, cede almost 80% of our business to the reinsurers. It has remained similar. Even on the retail side, the reinsurance strategy has remained same. So no change in the reinsurance strategy.
Okay. And in terms of solvency, then now that you raised the sub-debt, it's around 214%. So is there any internal threshold of when you would again require to raise this capital, or how long would this last?
We generally target for 170% and above. Though the breach as per the regulatory norm is 150, we generally target 170% and above, and that's on the basis of a very detailed analysis that our chief risk officer does, and it's a dynamic number. So 170% above. I think with the growth that we're anticipating, we hope that this will be good enough for at least next couple of years. But it completely depends. As things stand, with Axis Bank coming on board, we are reviewing our strategy. We are reviewing our growth strategy. We will review our product mix through this year. So depending on the outcome of that strategy exercises that we are undertaking, this may change up or down. But I can confirm to you that if we need capital in the business, that will be available through equity, and B, it will all go towards growth.
Yeah, thank you.
Thank you. The next question is from the line of Adarsh Parasrampuria from CLSA. Please go ahead.
Hi, Prashant and team. A couple of questions. First one is on protection, right? So we've gone through a bit of tightening, both in pricing and underwriting, and some of it will get passed on as well. So post the end of this whole period of so-called tightening, what is the expectation of whether you in the protection margins
Sorry, Adarsh, your voice is breaking. Can you please repeat your question?
Your line is a bit I can't hear you that well, Adarsh. You could just come close to the phone or something.
Sorry, Prashant, I'll try and talk a bit louder. So
Yes.
I was saying is pre and post all these tightening that we've seen on protection, right? It's been like 12 to 15 months or maybe 18 months. Where is protection margins and what's your outlook, right? Let's say before this tightening, and where do you think we end up on a normalized case basis?
So, I mean, generally we don't disclose margins at a protection level, but they continue to be similar. There is a target that we typically look at, and as and when the margin comes under pressure, we will increase the prices to maintain that level of margin. Needless to say, there is a bit of competitive play also, which could tactically make us, operate in a price range despite having a lower margin, etc. But one has been reasonably successful with that target approach, and we are able to manage that because somehow with all the reinsurers and with experience, it settles at that range. I would like to confirm that on protection, Max Life Insurance will be focused and we'll look for that kind of margin numbers. And, we experience over the last 4 or 5 years just that we will be able to hit that. As far as price increase, etc. is concerned, that's others, unfortunately, a very, very philosophical subject. For example, the big issue is to determine whether the COVID death claims are one-off or they are permanent. Because if they are one-off, then you shouldn't ideally go as a part of pricing because you will be penalizing people over a very long period of time, and you will charge them much more than what they ought to be paying. Number one. But if it is permanent, then we ought to be increasing the price. But how do you know whether it is permanent? So only time will tell. Perhaps we should be a bit circumspect, continue to monitor, work with insurance companies, look at tactical price revisions. And at this point of time, our belief is that COVID is a one-off and it should get settled. And, with all the reserves, etc., that we typically carry as life insurance company, we need to manage that and hopefully build those reserves again for any such future pandemic if it were to come through. But at this point of time, others, I'm not too sure if COVID has caused a fundamental increase in the mortality profile of Indians, because that will evolve over a period of time. That has happened. Of course, there's a business case to increase prices permanently.
Got it. And the second question, right? So the whole system and even Max has kind of seen margins go up because the non-par mix in the last 12, 15 months have kind of gone up, right? And then now, majority of the players say that there is a point at which you don't want the mix to go up beyond a point, right?
Correct.
Have we come to that point as a business? And then if that lever is exhausted and on the protection side, we are seeing some, still the industry consolidating a little bit, going through this tightening. What's the lever from a product angle?
From a non-par perspective, others from a non-par saving perspective, I've always maintained that we typically target a number of 35%. That's our kind of appetite. All the work that we're taking, they're taking discussions with the board. So that number is around 35%. In the first quarter, we were lower than that. So there may be an opportunity to shore up a bit on the non-par business. On protection, the belief that all of us have collectively as a group is protection is the core part of any life insurance company provider. So there is no point putting any cap on protection. We should write as much protection as possible, provided sufficient risk management practices are involved. We also hedge our protection book. I don't know if we shared that with you. We hedge our protection book. So overall, we will try to increase the protection share, protection margin. Now, COVID definitely is a one-off event and a pretty severe one, and that's why we are trying to be circumspect about it. But once COVID settles, I think the overall desire and aspiration towards growing the protection business will continue.
Got it, Prashant. This is helpful. Thanks.
Thank you. The next question is from the line of Abhishek Saraf from Jefferies. Please go ahead.
Yeah, hi. Thanks for the opportunity. Most of my questions have been answered. Just wanted to understand on this the claims that we had, 236 crores. So basically, we are seeing that those are the net claims, right? And since we are kind of reinsuring around 80% of our books, so gross claims could have been in the handle of around 1,300 odd crores. Is my understanding right on that, sir?
1,300 crores, Abhishek. Where did you get the number 1,300?
We are kind of reinsuring 80% of our.
That is only for the protection business, Abhishek. There is other parts of the business also, the savings part of the business.
So overall, it's close to 50-50. Overall 50-50.
Okay, so on total basis, so this 235 crores is net that we have means that we have retained on our book, and which is like net of what would have been passed on to the reinsurer.
Yes.
And the back is 260 odd crores is also on a net basis. So that understanding. Okay.
Yes.
Okay. So and that's fair. And the second question was on the protection price hike. So probably I might have missed when it was discussed. So what was the quantum of price hike that we took, and did we take it across all of our protection products or few of them? And in this line, means we also have been hearing that on group side, protection price hikes have been coming. So if you can just share that what has been our experience on the group side as well in terms of price hike, and if a number that you can share, that will be quite helpful.
So first question on the individual side, Abhishek, we actually deploy, pricing is a bit of an art and science that has to be kind of played through, and it is actually done across sum assured, age groups, the variant of the product, the length of the product, etc. So there could be certain places where there will be a very nominal hike, but it would have range anywhere between, let's say, 4 to 8% kind of a number happening across cohorts of our products. But it's giving a single number will always be very difficult. It's actually a triangulation of multiple things which happens on the price hike that is typically done. Now your question was on group. On group, term life business obviously has gone through a significant price hike. Term life business, as you are aware, is a single year business, and you kind of cover for a single year risk that is in play. And in single year business, given the pandemic situation, those price hikes have to be done. And even as part of our business, all the policy that we are pricing for the eventualities that could be there, and that's how the group term life pricing is happening. Credit protect policies, we are in conversations. Again, this will be dependent upon individual account. There is no single number that I can speak about the group credit policy. It will be dependent upon the kind of book, loan, years of the underlying asset, and also the kind of profile of customers that they deal with. So it's a varied number. Needless to say, as Prashant mentioned, it's a commercial enterprise which is trying to also ensure the profit profiles are protected. So those decisions are made basis some of those considerations.
Thank you. Our next question is from the line of Nischint Chauhate from Kotak Securities. Please go ahead.
Yeah, hi. You seem to be, alluding to the fact that you might go a little slow on protection business over the next couple of months, and there is some kind of a base effect that is playing out on the non-par side as well. So, what gives you, confidence to maintain a sort of a flat or a 26% kind of a margin for this year as well?
Because this question is coming again, I just gave a clarification saying that if you were to look at our margin last year, and because that's being discussed a lot many times, we hit about 25.2% margin, and quarter three were really good, quarters for us to do significantly higher margin business. We increased the proportion of non-par, etc. So from that perspective, your observation on overall margin profile appears logical, but please understand that this year we are growing year on year on our sales. When we grow on sales, there is the VNB increase that comes if we are able to maintain the margin. Number two is the trend that I'm seeing already. I mean, we just finished July. July numbers are not audited, etc. I can't share that with you. But that number is closer to the number that we did for the entire year. There is an increase already taking place. The third one is we are not going slow on protection. If you were to see our protection versus competition, I think we are going strong. Maybe it is a bit lower, but other people have gone significantly lower, and with that virtue, on our direct channels, on aggregators, etc., we continue to maintain the pole position. So, it's just that it is taking a bit longer to issue, etc., but we're not going slow. And if you were to look at last year, you would have seen that starting from Q1, Q2, Q3, Q4, the overall protection as a percentage of our sales was going down. So, in a way, how the future will unfold is going to be similar to how it was last year. In view of all the parameters that I mentioned to you, we are confident about maintaining the margin at a full year basis. Again, there will be quarters when it will go up or down depending on how it was last year. But overall, for the full year, we are reasonably confident of being at the same level or better than how we were last year.
Perfect. And what kind of an AP growth, would you be kind of, expecting for the?
That's a great question. Actually, we grew 19% year on year. It was a very difficult year. We significantly captured market share. So we are on a higher base effect, and I like to highlight that to everybody. On that, this year, so far the growth has been robust, and I'm just hoping that we are able to repeat similar or better performance than last year. Very hard for me to comment the exact percentage because we are not sure. But one just looks at the inputs. Our own channels have started to grow back much stronger just after the wave 2 got finished. Every month I'm seeing improvement in the growth profile of our own channels. We have our new promoter who has been our distributor for a long time. They are promoters. They are participating in the value, well-being, governance of the organization. So one would at the input level expect that we will get tailwinds from there. And overall, we have a base effect, favorable base effect playing out from Yes Bank. So I think at an input level, I feel very comfortable of our growth prospects, especially on sales level.
Thank you. Next question is from the line of Sriram Rajaram from Ratnatraya Capital. Please go ahead.
So what would be your online mix in terms of the overall premium, and if you could split that in terms of how much would be the share of aggregators versus the direct online channel?
Will you take that one, Amrit?
Yeah, sorry, Prashant, the line was on mute and I was speaking with myself. The online business for us actually has grown, at around 51% over last year, and a 2-year CAGR also of around 41%. It would be of our business around in the range bound of 2% in this quarter. Also, the question on mix, we actually do, it's more like a 50-50 kind of a sourcing. 50% happens through our own digital assets, which is, the consumer landing onto a Max Life Insurance page, and 50% happens through the aggregator ecosystems and other ecosystems that are in play. We typically have participated only in the protection business in this particular category. That has been our focus area. And always have, we have been assuming leadership position from a market share perspective in the online protection space.
That's helpful. Just to add, would that mix largely remain the same going forward? 50% from own and 50%?
Sorry, say that again. I just lost you.
No, would that mix largely remain the same, 50-50, in terms of the online?
I think because the opportunity and the pace at which this channel is growing, that opportunity remains, and both of them grow at a very healthy CAGR. So I would say that effort would remain to ensure that we are well diversified with business on our own websites and our own assets as well. and even also keep looking and evaluating an opportunities in the aggregator and ecosystems that kind of comes into play. It is difficult for me to answer that question very specifically that the mix will remain same, but our focus will remain similar to ensure that we are tapping into whatever opportunities and pools are becoming available where the customers are coming through the digital doors.
So the aggregator channel would be a focus area for the company. Right?
Yeah. It is continues to be, yes.
Thank you, sir.
Thank you. Our next question is from the line of Dhaval Acharya from Kotak. Please go ahead.
Hi, sir. My question is on the lines of annuity and retirement. How are we focusing on that piece? Because vis-a-vis the top three players, we are probably lagging there.
Yes.
What is our strategy? What is the outlook?
Your observation is absolutely right. That is definitely an area of focus internally. This year we are looking at growing both the businesses, annuity/retirement and riders. Those two we have identified as area of growth. We are looking at multiple X's of growth. So increase it like 3 times versus last year. We have to pick up pace. We just came out of the board meeting yesterday, and we had discussion around that also. So you're right. If we were to look at ourselves with respect to top three on how much annuity they are selling, I think there's ground to cover, and that definitely is a good opportunity for us because as we grow annuity, the overall profitability profile, etc., gets better. So the answer is yes on both accounts. Is that a focus area of Max Life Insurance? Yes. I also added the rider element to it because I believe that that's one more area that we need to focus on. And this year we are getting a slew of riders approved. There is significant focus, and for the first 3 months, the rider attachment has gone up manifold already. So I'm very optimistic that on both of these, Max Life has an opportunity for improvement, and we are very focused to grow there.
Also, sir, in the opening remarks, you did mention about applying license for the pension fund manager, which makes you overall formidable in the NPS and other varieties also.
That's absolutely the right observation. With that view, we have applied for the pension fund management business. We already have annuity service provider license. So we are going to look at insurance more in the format of ecosystem, not just selling annuity. And very extended discussion has taken place at our board level around that.
Sure, sir. Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
So thank you, ladies and gentlemen, for being on Max Financial earnings call. We look forward to more such interaction in the future. Thank you once again, and goodbye, and have a good day.
Thank you very much. Ladies and gentlemen, on behalf of Max Financial Services Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.